Hello and welcome to Wealthion's Weekly Market Recap. I'm your host, Andrew Brill. The tech sector got hit pretty hard this week, and the measure of market volatility is creeping north, up about 5 points from a week ago. Entrepreneur, financial analyst, and strategist Tom Lee joined Speak Up with Anthony Scaramucci this week. He believes there are sectors of the economy that are in recession, but is also bullish on other parts of the economy. With interest rate cuts on the horizon, he believes there could be at least two. Tom also touches on the crypto market and where he thinks it's going.
Tom is the co-founder and head of research for Fundstrat Global. He's a financial analyst, a strategist, an investor, a businessman, an entrepreneur, but he's also a fortune teller. Okay, you have to admit that about yourself, Tom. You are a fortune teller because you see the future before we do, which is why you're probably one of the most popular guests I've had on Speak Up. So let's start with your fortune telling skills. Talk about the economy. Where is it today? And where is it going, Mr. Lee?
Thank you for having me, Anthony. It's always great to have a conversation with you. So I'm glad to be here. In terms of the economy, I think the economy has defied the expectations of many because it remains pretty robust. Mainly because we haven't over-invested capital in the private sector. Companies have been cautious the last couple of years because since 2021, the Fed has signaled its war to fight inflation. It kept a lot of companies from overspending on CapEx. But there is a recession in durable goods and in auto sales and in housing. I mean, we saw that with existing home sales yesterday. I mean, they're just absolutely getting obliterated. And all of those three things in recession are really interest rate sensitive. So I think the economy probably is at a knife point where if the Fed begins to ease at the right time, and I don't know when that right time is, I think it staves off what could be a larger softening of the economy. But there is softness.
Let's talk about that for a second. Let's make you the Fed chair for a sec. Would you be cutting rates now? Would you be waiting? I understand that they're fearful of going too early because of the inflation dynamic, but it seems like if they don't go soon, you're going to have a steeper, deeper recession than's necessary. So where would you pull the trigger?
Well, I agree with your last point, Anthony. I think waiting any longer really does risk what is a cascade effect, right? As things start to slow, you unravel things very quickly. So to me, if I was the Fed, I'd be a lot less concerned about a second wave of inflation, which has haunted many FOMC members, with the realization that the things that have been sticky on inflation, like housing and auto insurance, they're finally turning, and there's not a goods reinflation cycle underway. So I would be cutting sooner. I mean, I think even the idea of a July cut makes sense.
But you're bullish. I mean, every time I see your interview, you're one of the people in my life that I have on Google Alert. Okay, I figure if you're talking, I need to be listening. So when I hear your interviews, you're bullish. Why are you bullish?
Well, I'm bullish now. In fact, I think today I would be buying small cap stocks pretty confidently because one, I think that we are entering a growth scare because things are slowing. But to me, that's only a scare because they turn on a dime or inflect as soon as the Fed starts cutting. Housing demand's going to come back big once people are confident Fed's going to cut, commercial real estate finds its bottom, et cetera. I think a second reason we're bullish is that when we speak to our institutional investors, and we have hundreds of institutional clients in 26 countries, and we speak to them frequently, they're far more cautious and far more skeptical of inflation, and I think have been more risk averse than we believe. And so when institutional managers are so cautious at a time when we're relatively optimistic versus consensus, that's also bullish. We also know there's a lot of cash on the sidelines. There's $6 trillion in money market balances. I mean, that's just a mountain of cash. Granted, it's earning 5%, but it won't earn that forever. And then when we look at demographic trends like millennials, I mean, they are really entering their prime working years. So there's a life cycle driver to their spending patterns. And I think there has been benefits from the, the growth of immigrants in the U.S. I know we're seeing the liability side at the moment, but that's a very large labor supply that keeps the labor market from overheating. So, I mean, I think there's many reasons to be bullish.
So, Bill Dudley, the president of the Fed, the former president of the New York Fed, is out with an op-ed today on Bloomberg saying that he got it wrong. He's changed his mind. He wants to cut rates immediately. Do you agree with him?
Yes, I've been following his comments because he is influential as a former member, and he has been one of those higher for longer, as you said. To inflect now and to call for cuts, to me, that's appropriate. And I think it's a recognition, and he's one of the earlier pundits to recognize this, is that there is a lot of softness out there. And if inflation isn't threatening, I'm not sure it makes sense to wait another 8 weeks to actually cut rates. So it's a pretty big air gap at the moment. And I think people get too caught up in the political noise thinking that this has anything to do with the election.
Would you cut 50 basis points?
I think the Fed could even signal that September is a definite cut date. And if it even is just one this year, I think it really reverses a lot of the softness, because the markets would take that cue from there and price in a series of future cuts, which is really, the market sort of has a lot of skepticism about how much cutting the Fed might actually do. But yeah, I would do at least 25 in July.
All right. So 25 in July. Is it crazy to get more than one cut this year?
Markets are pricing in 2.8 cuts, so almost 3 cuts this year. To me, the drop in core inflation justifies far more cuts from the Fed, because if we think of core PC running at 2.6 right now, and Fed funds are at 5.3, that's 2.7 percentage points of real rates. I mean, that's a penalty rate. I mean, that's the rate that you want to choke off the economy, and it's been in place for more than a year now. We fix the deficit through growth, or we have a huge deflation of the dollar. And in that case, of course, if that's how it's resolved, you really want to own something that's not dollar denominated. And it could be equities, but very likely it should be something like Bitcoin or gold.
Okay, so let's talk about that. Bitcoin has done great this year. It's up 50%. The ETFs, you see this cascade of money, this waterfall of money, exactly as you predicted. The halving happened. And so for those listeners that may not know what Bitcoin does in terms of the network spits out about 900 coins a day. And then sometime in April, it cut that coin distribution in half to 450 coins a day. And so the less supply you would think would move the price. The price has more or less been treading water here. You've got overhang issues. You had the supply onboarding of the government of Germany. You've got the Mt. Gox issue. Tell us about Bitcoin here. Are you still as bullish as you were? And what do you think happens to Bitcoin by the end of the year?
Yeah, we're still bullish on Bitcoin. Bitcoin has become an asset class now. It's now supported by a growing financial infrastructure, including BlackRock. I mean, when you get the BlackRock validating that as an asset class, it's not even close to being a flash in the pan. And I think many people forget that this is more of a signal of how much this asset class will grow over time, because when institutions got into private equity or venture capital as asset classes, something really well, Anthony, that signaled a multi-decade period where institutional sponsorship and ownership would grow. So I think we're only in the earliest stages of where demand is coming from a new source for Bitcoin that hadn't existed really since the first Satoshi was minted. And so I think that Bitcoin, unfortunately, is affected by, it's a hyper volatile asset, so it's affected by supply perceptions. not just demand perceptions. And on the supply side, you're exactly right. Mt. Gox is finally being resolved. That's really been one of the biggest expected overhangs since the original hack. And so when the distribution, which is in July, when that's behind us, and markets see that there hasn't been cataclysm, I think that's going to be a case for why Bitcoin does really well in the second half. The Germany distribution, that's very strange timing, but that's already behind us now. And I'd say the only thing that I think would hurt crypto is that it's still correlated and viewed as a risk on asset. So if the Fed is somehow unexpectedly tight, I think it would act as a headwind. But if the Fed starts cutting, I think you're going to see a move in Bitcoin that would correlate to what small caps would be doing as well. There's a lot of things correlated to a Fed starting a cutting cycle.
So 100,000 by the end of the year, is that possible?
Yeah, I think that 100,000 or even higher is possible.
Lawyer and CPA Mark Kohler joined Wealthion as a first-timer and shared valuable information on how to grow your wealth and save money on taxes at the same time. He explained how to use your own money to make you money and not pay taxes on those gains. You're talking about people who own businesses, and talk to me a little about, anyone can own a business. Even if you have a full-time job, you can still own a business or set yourself up like a business, right? To take advantage of these things.
Yeah. Well, after COVID or during COVID, we had the big formation, the great formation it was called. We now have over 40 million side hustles in America. 40 million, because people are struggling out there. They got to make ends meet. They're picking up a second job. They're driving a little Uber, doing a little bit on Upwork or Thumbtack or StubHub. I mean, they're just like selling whatever they can to make a few extra bucks. Can we change our mindset a little and say, all right, I'm going to get out of some debt. I'm going to pick up this side hustle, but maybe I could then turn that side hustle into a wealth building machine where I can just put away an extra 5 or 10 grand a year, 15 grand a year, and I can do it tax free. Most side hustles, you're not paying tax on that first 15K. I got plenty of write-offs. We can chew that up. So now you're building more wealth tax free, putting it away, and a side hustle, it's a gateway drug. People, that is a small business. If you're driving Uber, that's a small business. Get over it. It's a Schedule C. It's a freaking awesome little write-off. And that again opens the door. And people, if they just realize they're sitting on a gold mine, they see their side hustle as a burden, as a problem, as a inferiority complex. Sorry, that's a tongue twister, but it's really an opportunity. Estimates are around 70% of Americans have an old 401k from a prior job, anywhere ranging from $5,000 to $100,000 just sitting there, and they don't know what the hell it's in. And sometimes it's just languishing back at the old employer. So the step one is to take that 401k and roll it to an IRA. So we want to roll it to a self-directed IRA at our trust company, directedira.com. You roll the money. There's no penalty. There's no tax. You just moved it from essentially Merrill Lynch to Fidelity. You've moved it from Fidelity to directed IRA. On day 3, we call you up or email and go, what do you want to invest it in? So you got this IRA, and we have the stock platform, but if you have a stock platform, just go over to Fidelity. But if you're like, no, I want to loan it to my sister's small business, or I want to do a promissory note on a first trust deed to a contractor down the street, or I want to buy a rental property, then you fill out a bi-direction letter, and you would tell us, I created this new LLC. I want you to put that money in as the 100% owner of the LLC or a 20% owner. And by the way, my kids are Roth IRAs coming in, whatever, my mom's, my blah, blah, blah. So you set up this LLC. Our law firm's been doing this for 20 years. And that LLC is created. Your IRA funds the LLC in exchange for a membership certificate. This is like on day 4 or 5. Most of these we turn around in 10 days. And then the LLC has its bank account with your IRA now funded in there and what other pool of partners you bring together. And you're the manager of that LLC. No one else. That's not prohibited. Now, you can't give yourself a paycheck. You can't buy yourself a new cell phone or go to Hawaii and look for rentals. But you're going to manage that LLC, and you can start directing it, directing it into what you know best. We take no fee. That's your money. And so you get to self-direct it in that LLC and build it up. Peter Thiel started in 1999 with $6,000 or $5,000 in a Roth IRA, I think. It's now worth $6 billion. And every time he passed go every year, he'd put $5,000 in, $6,000 in, whatever the annual contribution was. But your return is unlimited. And so that's how you self-direct. It's that easy. I have a health savings account with an LLC, and I own this cute little low-income housing deal in South Chicago. It's the cutest little meth lab. And my health savings account owns that. So I've got rent from a rental property going tax-free into a health savings account that paid for my daughter's braces, tax-free. You can direct your HSA, your kid's college savings account, the ESA, Roths, 401ks, SEPs, simples, blah, 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 blah. So fun.
And on and on and on. Wow.
Yep.
I had another question, but you had mentioned trusts, and what's the advantage of setting up trusts for certain things? Do you set up trusts for real estate? Do you set up trusts for your savings? I mean, my wife and I are at the point where, like, we own 2 homes, and do we set that up in a trust just to protect our kids? And is that a wise thing to do?
It is. And there's so much misinformation out there in the industry on this. There's a lot of wolves in sheep's clothing that are overselling elaborate trusts, irrevocable trusts that are completely unnecessary. So let me say this to everybody listening. And if I say something here that conflicts with the advice you've received, anyone listening, please get a second opinion, because I stand behind this. 25 years as a lawyer, helping small business owners all over America. I've done my 10,000 consults. I've got 5 books out there. I write for entrepreneurs. I've got the credentials for this, people. I am standing behind this. 99% of Americans, all they need is a revocable living trust. It's a trust that you control during your lifetime, with or without your spouse, single, married, whatever, no kids, young or old. And that trust becomes the owner of all of your assets, your home, your 2 homes, your LLCs, your S Corps, beneficiary of retirement accounts. That trust can be modified at any time. It can have all sorts of rules. My kids get a third when they turn 25, a third when they turn 30, a third when they're 35, money to start a business, money to buy their first home. And if I'm still alive, I'm in control. It's a revocable living trust. 50% of Americans don't even have a will. We have a whole billion-dollar industry called probate court and probate lawyers, probate judges, because people don't plan. They think they're going to live forever. If everybody had a will and a trust, there'd be no probate. That's it. And so the revocable living trust is a wonderful trust to stay organized, create some privacy. I love privacy. And there's no asset protection with it. It's about a legacy. It's about privacy. And it's about being organized. Now, that other 1%, sure, we might do a domestic asset protection trust or a charitable remainder trust, a life insurance trust, ILIT, in very unique situations. So if anybody listening is getting pitched a $5,000, $10,000, $20,000 stupid asset protection trust structure, 2 LLCs in Wyoming and 1 in Nevada and 1 in people, I have never, ever, ever done that in my practice, and it's a waste of time.
I appreciate that. Is there a benefit to trying to set yourself up as an LLC with your employer? If your employer, obviously you lose the health insurance, you'd have to worry about that on your own. But if your employer says, okay, we'll make an independent contractor and we'll pay you as an LLC, is there a benefit to that?
Yes. Now, we're making a big assumption. States across the country are continuing to crack down on this because state unemployment, federal unemployment, workers' comp, FICA, the government, federal and states, do not like it when we try to convert an employee to a sub unless they really are a sub. So we want to make sure, and the risk is on the payor, not the recipient. If your employer shows up and says, hey, I'm going to give you a 1099 and not a W-2, say, okay, take it and run. If anybody gets in trouble, it's them. So employers have to be very, very careful. If it looks like a duck, quack like a duck, walks like a duck, it's a freaking duck. And that's the same way it is with employees. Now, so let's assume you can qualify as a subcontractor and an employer's previous employer can now treat you like a subcontractor and you have a client. So we're not going to say paycheck or employer ever again. You have a client that's going to pay you as a subcontractor. If you're making more than 50 grand a year, you absolutely have to be an S corporation. Now, you may take an LLC and convert it to an S. You may just come right out of the gate as a PC or an Inc. But an LLC does not save taxes. LLCs do not save taxes. They're for protection, for structure, for organization, for branding. S corporations, S is in small. That's not escorts for those that are going to Vegas this weekend. They're S corps. S corps save taxes. And you just take an LLC and make an S election. It's super expensive. We charge $200. So you make that S election and you're off to the races. So yes, if you can get that relationship set up, hell yeah, all day long.
So, I've heard about converting your 401k to a Roth. You pay the taxes, but you convert it to a Roth. But now you've taken that, and there was a great article, exactly what you alluded to. There's a great article in the Wall Street Journal saying that there are billions upon billions of dollars sitting out there for people that have changed employers and completely forgotten about their 401k, and it's just sitting there not really making any money because they haven't directed it to make any money. It's sort of put on hold. So you're absolutely right about that, and the Wall Street Journal confirmed that people don't, once you leave your employer, they forget about the money they've actually put away for themselves. It's their money. So but converting your 401k to a Roth, benefits?
Oh, absolutely. And let's even back up here further. I know there's listeners out there that have already checked out on this topic. They're saying, my accountant said I make too much money. I can't have a Roth. Okay, let me repeat that. There are people listening right now that have been told by a dumbass that, excuse my French, people out there have told you you can't have a Roth or contribute to a Roth because you make too much money. It is outright misinformation, wrong, lie, stupidity. You can fund a Roth at any age with earned income at any income level. You use the back door. Now, if you want to go to the Roth party and walk in the front door, your income can't exceed 200 grand-ish, single or married. There's all the levels. I could read them off here. But you can go to the back door. What you do is set up a non-deductible traditional IRA, make your contribution, convert to Roth on the next day, tax-free. It's called a Roth conversion, backdoor Roth. Google it, people. I've got articles out your yin-yang on this. So that backdoor Roth non-income limit procedure is what allows anybody to convert a traditional old 401k or traditional IRA to Roth as well. I could convert $1 million tomorrow to Roth, any income level. Now I got to be ready to pay the tax on it. So what we teach is Roth chunking. If you came to me and said, hey, Mark, I've got a $500,000 traditional, I want it to be a Roth. You will always win in the long run being a Roth, especially the higher your rate of return, especially if you're self-directing, the higher your rate of return, the more the Roth wins. Because see, what the naysayers are saying is, well, you get a tax deduction now, and then when you pull the money out, yeah, you're going to pay tax, but you're going to be in a lower bracket. Oh, really? You've got a crystal ball. And do you know what my rate of return is going to be too? Because I'm going to have so much more money in this self-directing that when I pay tax on it, it's going to hurt. No deduction up front is going to pay for that crap. And so, oh yeah, well, if you change that, well, yes, because I'm not in Wall Street. I control my own damn money. So I've got money in Wall Street too, but I also self-direct and I have real estate. We want to be diversified. And that doesn't mean multiple types of stock. Okay. So anyway, converting to Roth wins every time. And I look at a client's tax bracket. So Andrew, you say, hey, I want to go Roth. Okay. What bracket are you in right now? Oh, in the 7 brackets right now, there's 2 break points where it's an 8% jump on to the next bracket. We never want to convert too much Roth that pushes us over one of those 2 break points. So if I'm going to only go up a 2% bracket or a 3% bracket, I'll say, ooh, I'll convert 100K this year, 150K. Hell, I'll even take out a mortgage on my house to pay the tax on that because I'll never pay tax again. Done. I just funded my retirement tax-free ATM for life. So let's pay that tax now. Go self-directed, get a 10, 15, 20% return, numbers off the chart. So I want to chunk at it, and maybe over 3, 5, or 6 years, I've now converted everything to Roth. but I don't have to take a bloodbath in 1 year and jump into a tax bracket that doesn't make sense. That's called chunking, Roth chunking. I got it from Chunk in the movie Goonies, 1984, Steven Spielberg. Thank you.
Yes. So that's another place. Now we go back to the real estate. You can actually, because you put, let's say you put in $100,000 into your Roth, that grows tax free. But at a certain point, you can take that $100,000 out tax free and use it to buy real estate.
Okay, well, first of all, I can put the money in my Roth and buy real estate now and grow it, flip properties, buy rentals, whatever the hell, double my money, triple my money, do developments, commercial developments, whatever, inside my Roth right now. I'm not pulling it out. I'm not paying penalty. I'm not paying tax. I'm building it tax-free. Then when I've had the Roth at least 5 years or 59 and a half, whichever's longer. So if I start at age 50, getting this going, by age 59 and a half, whatever's in that Roth, I can walk to the ATM and take it out tax-free anytime I want. There's no RMDs. There's no penalty. There's no tax. I love Dave Ramsey celebrates debt-free day. You know, when people finally pay off all their debt, they like video and it's my debt-free day. We celebrate 59 and a half over here because clients are now tax-free because we've been building our Roth. We want to build that Roth. So at 59 and a half, I can go grab money anytime I want and I can keep investing it. I can keep putting more money in it.
eToro's options analyst Bret Kenwell gave us his analysis on the real estate market, current state of the economy, consumer spending, and the likelihood of the Fed cutting interest rates near term. He also talked crypto and the Ethereum ETF, and also explained the difference between Bitcoin and Ethereum.
And what about real estate? Because I'm reading more and more about how there's various pockets in the U.S. where they're experiencing a lot of weakness. And I'm thinking about Austin, Texas, and also pockets throughout Florida. A lot of supply coming onto the marketplace, and there's no buyers. Any thoughts on that, or did you see or read any commentary from any of the banks about excessive loan loss provisions associated with real estate?
Right. So the real estate picture is pretty complex, I'd say. I'm not a real estate expert or a real estate analyst, but it's a complicated situation when you look at not only by region to region, but the different types of real estate as well. Commercial real estate obviously being the big concern for banks, generally speaking, and for a lot of investors. And even by banks, it varies a lot, whether we're talking about a smaller regional bank or a large commercial lender. So there's a lot of different variables to consider on the real estate front, and I'd say there's still certainly some concerns there, but so far we haven't, those concerns haven't come home to roost yet, I guess is how I'd put it.
So I want to get your thoughts on the economy now, because it's often said that the stock market is not the economy. So in spite of how well the stock market is doing, we're seeing weakness throughout the economy, and we saw a weaker Q1 GDP number. It was also revised down from 1.6 down to 1.3. We have a Q2 number coming out, I believe, sometime this week. What are your thoughts on the U.S. economy, and do you have any thoughts on this GDP number that'll be coming out?
This is where things can get a little bit tricky, particularly for the Fed. And we'll probably touch on rates in a little bit, so I'll save some of that for then. But the Fed is trying to balance keeping its policy restrictive enough to bring down inflation, but not so restrictive it pushes us into a recession. And throughout this whole phase of having this higher for longer interest rate environment, the U.S. economy has continued to chug along pretty well. Q3 and Q4 were very strong last year. But then, like you mentioned, Q1 came in. First, it came in weak. Then it was revised lower. Then it just came in it was growth, but it was not impressive. The estimates for Q2 stand around, around 1.9%, depending on what forecast you're looking at. But generally speaking, the growth is just considered mild. It's not wowing anyone, but it's maybe not concerning anyone yet. I think when you look at the last few months of data, though, it's really important for investors to remember that 70% of the U.S. economy is driven by consumer spending. The consumer is incredibly important to the U.S. economy, and because of that, the labor market is incredibly important to to the U.S. economy. And that might seem like common sense, but that's not necessarily the case all the time. But in the U.S., that is the case. And so when you start to see, retail sales come in light, when you start to see payroll numbers come in a little lower, unemployment rate tick up, jobless claims, come in ahead of expectations, you start to see some of those, and you ask yourself, is the consumer okay? Is the economy going to be okay? And unfortunately, these things take a little while to work through the system, and it kind of has a lagging effect, a lagging indicator on how the economy is doing. But yeah, I'd say like we kind of said at the top of the show, it's softening. I wouldn't say it's weak, but these are all factors investors should certainly be taking into account when it comes to not only stocks, but how they're allocating money and what the Fed might do later this year.
So yeah, you raise a very good point, because the consumer in the U.S. very important. They represent 70% of GDP. So whatever the consumer does has a massive impact on the economy. And I just want to bring up one fact. Back in Q1, both Starbucks and McDonald's came out, and many other companies came out and said consumers just were not spending as much money in their stores or the restaurants. And it's going to be interesting to see what both Starbucks and McDonald's and the other restaurant companies have to say for Q2. But what are your thoughts on the U.S. consumer here? Do you see any other concerns in terms of spending or lack of spending?
I would just say in some of those cases, I think I think some of those issues can be company specific, without a question. But on the other hand, when you start to see it collectively at more than one, it's not just one or two companies we're hearing this from. We're hearing it from a lot of consumer-based companies. And so, I would say the consumer is flexible. They can handle a little bit of, price increase and certainly welcome price decreases. But when they look at higher prices at the pump, when they see higher prices at the restaurants, when they see at the grocery store, all these different areas, they're flexible, but the consumer is not a world-class gymnast. They can't bend over backwards at any price hike. And so at certain points, these companies are realizing that there will be backlash and there will be pushback from their customers. And we're seeing them respond, I'd say in many cases appropriately by, innovating their offerings and trying to get lower priced options in front of the consumer to get those customers back in the door. But generally speaking, a softening in consumer spending is a concern for the broader economy as a whole. But so far they're holding together, but they're certainly off the highs.
Well, what are your thoughts on Bitcoin, and is it going to take off as we go into year end?
I think you said it well. I think it continues to consolidate. We look at the move not only from last fall or year over year, which has been a tremendous rally in Bitcoin, but even off the lows this year. Coming into 2024, the expectation was we would get Bitcoin ETFs. We got them in early January. Bitcoin rallied into that event. They did the typical sell the news reaction, a nice healthy pullback, and then Bitcoin almost doubled, rallied like 90% to its highs in early March. And since then, we've just seen a consolidation. I think that's great. Might be frustrating for longer term holders, might be frustrating for bulls, but at the end of the day, consolidation after a big rally, that's great stuff. If it resolves up through the highs and if the fundamentals remain intact, then we could be definitely looking at higher prices for Bitcoin.
So the other big news in the crypto space is Ethereum. Why don't you tell us about that? What's the news?
Yeah. So in May, expectations were pretty low that the SEC was going to give the green light for Ethereum. They surprised the market. They warmed up to it. They set the stage for approval sometime this summer. That approval process is complete now, and now we look forward to the trading of, I believe it is 8 Ethereum ETFs will hit the market. eToro's always offered Ethereum, the coin, the cryptocurrency, just like Bitcoin, and like the Bitcoin ETFs will offer the Ethereum ETFs. But generally speaking, I think it's a good thing. I think it was a good thing for Bitcoin when they got their ETFs, and I think it's a good thing for Ethereum. Anytime an asset class has the potential for, an asset's price is driven by supply and demand. So anytime that the market can find a way to increase demand, and in this case, by offering the Ethereum ETFs, gives another way for investors to buy Ethereum that may not be so comfortable going out and buying the actual cryptocurrency, but they feel a lot more comfortable with an ETF, a product that they're familiar with, and have used before. It just gives another chance for more demand, gives a chance for more price appreciation. I think it's a positive for the industry as a whole and for investors as a whole.
But what is the difference between Bitcoin and Ethereum, and why would I invest in one versus the other?
Ethereum tends to have more applications than Bitcoin, and Bitcoin, by many people, is considered a store of value. But the way I would look at it is, Ethereum tends to be the number two to Bitcoin, and that's just the way it goes. Bitcoin is by far the most popular cryptocurrency, and it's the most well recognized one. And for me, I think those two will probably move, not necessarily in lockstep in terms of percentages, but I think they would move in lockstep in terms of direction. And at certain times, Bitcoin outpaces Ethereum. In other cases, it's vice versa. But me personally, I do like to go with the names that are that have larger market caps, have more market recognition, and even though they might not have some of the explosion that some of the smaller cryptocurrencies have, and I'm not a cryptocurrency expert, so I don't typically get into the smaller coin situation. And I know people make great cases for them, but I like names that have large liquidity, large recognition, and large market cap. So those are the top two for me.
With gold being a big topic of conversation these days, especially with the election coming up in November and the possibility for the devaluation of the dollar, James Conner put together a video on how to buy gold and the different ways to invest in the precious metal.
When purchasing physical gold, you have two options. You can buy physical bullion, or you can purchase a gold coin like an American Eagle or a Canadian Maple. Gold coins will always cost a little bit more due to the minting charges and also the cost of production. When you buy gold bullion or coins, deal with reputable dealers like our sister company, Hard Assets Alliance. Hard Assets Alliance is a trusted platform used by over 100,000 institutional and retail investors, and it has over $3 billion in assets. Hard Assets Alliance will deliver the gold to you personally, or you can store it in a vault. All the holdings in the vault are reconciled daily and audited by an independent specialty firm on a regular basis. All holdings are also insured at all times for their full replacement value. The second option available to investors are gold ETFs. Gold ETFs are traded on exchanges like stocks and can be bought and sold the same way. ETFs are extremely liquid, and they don't have the premiums or the storage and shipping fees that come with buying bullion. It's important to understand, though, that many gold ETFs are not backed by gold bullion at all, but are instead backed by futures contracts, and therefore they're referred to as paper gold. The last option available to investors is also the highest risk option, and that is acquiring shares in a gold mining company. I'm sticking to producing mining companies only. I'm staying away from exploration and development companies just due to the excessive risk levels. Investing in mining companies that are producing can provide additional leverage to the price of gold, but that higher leverage also comes with a higher level of risk. And I want to outline the various elements of risk. There's operational risk. Gold miners are profitable only if they can extract and process the gold at a profit. If they run into any sort of complication associated with the processing of that gold, then the gold miner will lose money. Another risk is geological risk. All gold mines have a finite life, and so it's imperative for the gold mining company to explore. And sometimes they might spend tens of millions of dollars every year looking for new gold reserves. So there's also the risk that the gold company can't find any more gold and that the gold mine runs out of gold. Another common risk is geopolitical risk. If a gold mining company is operating in a country which does not respect the rule of law, then it's possible that a country can nationalize the mine and in effect steal the mine from its shareholders. And this has happened numerous times, especially if the mine is highly profitable. In short, mining companies come with many more risks than you will find with owning physical gold.
Thank you for watching this week's recap. Don't forget to head over to Wealthion.com for a free, no obligation portfolio review with one of our registered investment advisors. And please follow us on social media for the latest news and information to help you invest wisely. If you haven't done so already, please make sure to like and subscribe to our channel. And don't forget to turn on notifications to the channel so that you never miss a video. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish. If you like this content and are looking for more ways to keep and grow your investments, watch this video next.